Joining me now is Dana Telsey, Telsey Advisory Group CEO. And Dana, it's great to have you on. They reaffirmed their full-year guidance, but they also said that they're not including possible tariff impact into that guidance. Your thoughts on what this says about Levi, what we can expect from other reporters in coming weeks, and the importance of a diversified supply chain?
I think a couple things. And first of all, Morgan, thank you very much for having me. They beat the quarter. They maintained the guidance. You look at the sales growth in the quarter, up 9%. The sales growth for the year is guided to 3.5% to 4.5%. So they left themselves room. No one knows what the magnitude of these tariffs could be. All we know that is it's not good, given the pressure it puts on the consumer, given the pressure it puts on these businesses. So maintaining the guidance with a beat gives them some wiggle room. The diversification of sourcing that they talked about is certainly critical, but prices are going up. It'll be shared by the consumers and the manufacturers, and retailers and consumer companies are going to diversify. I've been speaking to a ton of companies over this weekend, and the amount of change that needs to happen is very complex, and companies are being very cautious about orders going forward because bringing goods in early allows you to get a better price. The fact that they got better sales, that their DTC business was strong, that the margins were solid, this could look like some of the better ones during this earnings season coming up. And keep in mind, they didn't give guidance to the second quarter. Let's hear what it is, because being able to beat, and they're basing in for basically more conservatism going forward through the year. And I think that's what you're going to see from consumer companies.
So something very interesting happened with Ford last week in the midst of auto tariff implementation. And that was they announced that they were offering employee discount pricing to all of their consumers. And then to follow suit, Stellantis is now doing the same thing. So it almost seems like they're leaning into a pricing war to potentially gain market share and boost their brands. Could we see something similar happen on the apparel or retailer side? And if so, who'd be best positioned for that?
A couple things. First of all, when you look at the average ticket of what a car is compared to what apparel items are, very different. I think the competitive nature of what you're going to see, the scale of what Levi's is with their market share, they'd be one of the best positioned also because of the diversification that they have in sourcing. But you look what wins during this period of time, where you have more North American manufacturing, that's Bath & Body Works. What wins is where you have value, and that's TJX and Burlington with the off-pricers. And you also take a look at what are the essentials consumers need, and that's the grocers and that's the Costcos of the world. So I think what we don't know is what the level of consumer demand is going to look like when they look at their 401k statements.